What is debt? Debt is a fundamental element in the capital system, driving the operations of governments, corporations, and households. It is the commitment of a borrower, debtor, to repay money borrowed from a lender, creditor. Governments finance infrastructure projects, corporations fund their business operations, and households acquire homes or education through debt. While debt is crucial for economic growth, it has also been at the core of many financial crises, as failure to repay loans can damage creditworthiness and restrict future borrowing opportunities. Household debt refers to loans taken by individuals or groups, allowing them to use future income for current needs. Examples include home loans, car loans, education loans, and credit card debt. Borrowers must make periodic repayments, including interest, over the loan's tenure. Household debt levels offer insight into the consumer economy and can be a critical macroeconomic indicator. High levels of household indebtedness can affect consumption patterns and overall economic growth, while stable debt allows consumers to maintain spending and demand, contributing to economic stability. Corporate debt is a major source of funding for businesses. Through debt financing, companies can raise money for both short-term needs, like paying salaries, and long-term investments, such as building new facilities. Corporations often turn to the bond market to raise capital or secure loans from banks and financial institutions. While debt can offer a relatively cheaper form of financing compared to equity, it also comes with the risk of default. Excessive debt can lead to financial distress, especially if a company's revenues fail to cover interest payments. Corporate debt, therefore, must be carefully managed to avoid bankruptcy, while providing the necessary capital for growth and expansion. Government debt is issued by national, state, or local governments to finance public expenditures and development projects. Sovereign debt is considered a relatively low-risk investment, with government bonds often regarded as risk-free assets. The yield on government bonds reflects the risk-free rate of return, influencing broader financial markets. However, governments must maintain sustainable debt levels to ensure financial stability. Excessive borrowing can lead to rising interest rates and deteriorating credit ratings, which would increase the cost of future borrowing. Credit rating agencies play a crucial role in the debt ecosystem, assessing the creditworthiness of borrowers, whether governments, corporations, or individuals. Their ratings affect borrowing costs, as a lower rating indicates higher risk and leads to higher interest rates. Maintaining a favorable credit rating is essential for borrowers seeking to minimize their financing costs.